Darwin Bailey, Time Lord here, and we're reviewing May 2018 and fishing strategy with Miles Anderson of Milestone Investing. So Miles, tell me, was May a good month?
On the whole, it was.
Why
It
was that?
a pretty good month. So I can give it to you blow by blow by each week, shall I?
Yeah, that's
Because
brilliant.
that's how the newsletter comes out.
Yeah.
There were 5 weeks in May.
Yeah.
The first week, we had next dividend date of the 3rd of May.
Okay.
And the qualification day was the day before, 2nd of May.
Yeah.
Here it is. And there were 3 candidates that week. Mondi, Kingfisher, G4S.
Okay. Tell me about them then.
I'll let you just marinate for a little while.
Yeah. I think you'll have heard of most of those companies.
Okay.
What do they do?
So Mondi delivered for us a dividend yield of 6.1 in the end.
Yeah.
It was, in fact, this one was promising a smaller yield.
Right, okay.
But the share price clearly fell and the yield went up.
Yeah.
6.1% yield and 81.8%
Wow.
derivative
I think
yield.
you said that to me before.
And
I hope you got that figure. 81%.
And it took 13 days to get your money back.
1%. Okay. Wow. So you invested, before you go on to the others then, I'm a new person trader. I've got £10,000. Mm-hmm. How much of it am I investing in Monday at the beginning of May?
10,000.
Yeah, if I've got 10,000.
If you're sensible and you're a newbie, you're going to be putting in a quarter of your fund.
So £2,500.
Yeah.
Okay.
Now, for those of you who think that's too much exposure, this is a strategy that's investing in something that is actually guaranteed.
Right.
What's guaranteed is a dividend.
Yeah.
What's not guaranteed is how the share price will react after the dividend payment and before the dividend payment.
Okay.
That's the volatility of the market.
However, and when you might get your money back as well.
The answer is yes to that. But if you know how to hedge, then you can actually protect yourself from the downside of the volatility of the markets.
Okay.
So, and the hedging is like a strategy where you almost it's like taking out an insurance to mitigate the downside of your trades.
Yeah.
If there is a downside.
Right, okay. So that's Monday, 81%. Now that's a good start to the month. What else was in that week?
In that particular week we had Kingfisher and we had G4S.
Okay.
So Kingfisher delivered 33%.
Okay.
Derivative yield, not dividend yield. And G4S delivered 22. So let me tell you how quickly you got your money back. In the case of Kingfisher, you got your money back 7 days later.
7 days.
And in the case of G4S, 8 days later.
7 and 8 days. Wow. Wow.
And then Mondi was 13 days.
13 days.
Yeah.
Okay. So in 14 days, 10K, you've invested £2,500, you've got it all back after 13 days.
Yeah, and you got 80% on the £2,500.
Yeah.
Yeah.
Wow. Okay. So that's a good start to May.
So, but let me actually show you the implication of that.
Yeah.
So you actually understand what just happened.
Yes.
Because you put a quarter of your fund in.
Yep.
You need to take the 80%.
Yes.
And divide it by 4.
Right.
And now you've got 20% on your whole fund.
Right. Okay. Yeah.
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 So if you get 20% on the whole fund in 2 weeks, you're doing well.
Very well.
You're doing very well.
So that's the reality of it, and that's the reality of how this strategy of dividend fishing can actually work.
Yes.
Okay. So is 81% normal?
No, 80% is up there. It was the best performer for May, so it's an outlier effectively. It's not my bar. I set the bar at 20%, and so anything above 20%, I'm interested. So 80% is clearly way above it.
Way
above
times
20.
above.
Yeah.
Okay. So 20%. So sort of 20% is good. 30% starting to get quite good, and then 50% really there, and then 80 is way off the stratosphere. Really, in reality.
There are ones that they pay more than that.
Really?
Oh yes, there are. But like I said,
do you know when they're going to come from your data? Like in another video, we explain about regularity and so on, dividends, some of these companies.
Yeah.
Can you predict when they're going to be in the year?
The companies declare anywhere between 6 days and 3 months in advance when they're going to pay dividends.
Right.
So you know when they're going to pay them.
Right. Okay.
And I would say this to you, with only one exception in the last 10 years, have they not delivered on their promise?
Right, okay.
One exception
What was
in
that
10 years.
exception?
Do you know, it was a mining company, and a company won't come to mind right now, but they went through a really bad patch and they couldn't afford the dividend. They knew they couldn't afford it some time before,
Oh, so they
after
announced-
announcing.
right.
So they actually went back to the press and announced it. I think it was one day before. It was one day. It was one day before. We was watching Sky and it was there. So I alerted all my subscribers. That company I told you about on Monday, forget about it. We're going with option number 2.
You're right, okay.
Because I just seen a report that they basically can't afford dividend.
Right, okay, but that's the only time it's happened.
That's the only one I've seen in 10 years. And so essentially, come on, one dodgy performer in 10 years.
Yeah. That's not a bad record, is it?
That's
not
it.
really.
I don't know
Because
anything better.
presumably you're investing in right from solid, large blue chip companies right down to sort of are all companies quoted on the FTSE 100
Okay.
or 250?
I stick to the FTSE 100.
Okay.
It's called safety.
Okay, so all of
do
these
safety
companies
reasons.
okay, that's a fair point. So all of these companies you can look up in the stock exchange, online, whatever, every single day, and that data is, share prices and so on, is accessible to everybody, and that's
Yes.
what you're investing in.
And I would even say this. I would say if maybe 70% of the FTSE 100, everyone knows them. They're all brand names.
Yeah.
I'll give you an example. Sainsbury's.
Yeah.
Who doesn't know Sainsbury's?
Yeah.
You see what I mean?
Yeah, well,
They're the biggest companies in England.
some people living on Orkney Islands might know. Okay.
Yeah, but they know Tesco, though.
Yeah, well, cool. So, next week in May, what happened then?
So the following week in May was the ex-dividend date was on the 10th of
Yep.
May, and the qualification date was one day before, the 9th of May. And we had in that week, there were 7 candidates in total, and only 2 met our criteria,
Above the 20% bar.
above the 20% bar. One was Centrica, one was Admiral.
Right.
Yeah, Centrica and Admiral. How did they get on? That was a week where we didn't do well on the upside,
Right.
and so basically they haven't recovered yet.
Right.
But because we knew they were not ones that recover quickly anyway, we would have employed a shorting strategy.
Yep.
Now, a shorting strategy. What am I saying here? When the market's going up, and you buy and then sell at a later date.
Yes.
So you buy at 20p, for example, and sell at 30p, you made money. And that's called going long.
Yep.
When the market is going down and you open the trade at, say, 80p and you close it, you basically sell first. You sell at 80p and then you basically buy it back later, say 20p.
Right, okay.
You made 60p gain, but you do the reverse. You do the buy and sell in the reverse order.
Yeah.
Yeah. When it goes down, you make money. That's called shorting
Yep.
the market. Okay. So if you short the market when the market's going down, you'll do well.
Okay. So which companies did you
And
invest in?
in
that
those
second week?
case, we knew that Centrica
Yep.
and Admiral were not going to do so well on the upside. So we basically shorted those. Now, how did they work out in the end? We're still waiting for those to recover on the upside. So
Right, okay.
obviously,
So you're waiting for the money back, basically,
yes.
on those. Yeah.
So let's give some context. Week 1 was great for going
Yep.
long. Week 2 was great for going
So
short.
different strategy.
Different strategy.
Within 1 month, within 2 weeks, different strategy totally.
Yeah, and it's what I would call, it's the 4th element of making money in our dividend fishing strategy.
Right, okay.
So I talk about 4 ways of making money. 3 of them rely on the share price going up, and 1 rely on the share price going down.
Okay.
And that was the example for
Okay.
that.
Week 3.
Week 3. Well, week 3, we had the ex-dividend date of the 17th of May.
Yep.
We had the qualification date of the 16th of May. There were 3 companies, HSBC, Intertech, and Tesco.
Right.
None of those 3 hit our 20% criteria.
Okay, so what'd you do?
We didn't trade.
Oh, you're not making money that week.
That's okay. We made 80% the week before. So
I
that's
know.
all right.
You got 3 strategies within the 3 weeks. Straight away.
Or 3 ways
3 ways of
of
3
operating the
responses,
strategy.
if you like.
Absolutely
3
correct.
responses.
That's correct.
Okay.
And here's a key point here. There are times when it's not good to invest. Don't trade.
You've got to recognise those
Yeah,
times.
when you recognise now is not the time to get involved, just stay
But
stay
that
with
is, we
cash.
covered another video about emotions dictating share prices and so on. And one of the emotions is greed. And
Yes.
some people might
And
still
some fear.
invest because, oh, well, I don't mind going below the bar of 20%. I'm happy with 15 or whatever. Why do you have a bar of 20%?
A couple of reasons. We are taking a risk jumping into the market.
Yep.
I want to know that the risk-reward ratio is actually one that's worthwhile.
Okay.
I'm not going to jump in to make a tiny percentage. So I'm not going to say, for example, risk 20% to make 5%.
Right.
That doesn't make sense to me.
It's not worth it.
No.
Yeah.
I want to flip the numbers the other way around.
Yeah,
I can risk 10% to make 30%. That makes sense.
Right,
But not when it's adversity again against you. And when the returns are too small, it's not really worth it.
Yeah.
Now, don't get me wrong. There are some times when the low performers absolutely outstrip all expectation.
Yeah.
They really do. But we're just guessing, because I don't know that's going to happen.
Yeah.
And I want to do things I can predict.
Yeah.
I can predict they're going to pay a dividend. How do I know? They told me. They told me anywhere between 6 days and 30 and 3 months in advance. I know when they're going to pay a dividend.
So that's 3 weeks, different responses. Week
Yes.
4.
Week 4. Week 4, we're looking at the 23rd of May, qualification, 24th of May, ex-dividend. We are looking at Morrison's. In this week, there were 6 companies that were paying dividends, and 2 of them hit our 20% criteria. One was Morrison's, one was Whitbread.
Right, okay. Presumably, though, that marketplace, Morrison's, Tesco, Sainsbury's and so on, is dependent upon a lot of factors whether you would still invest in those companies.
Even though I invest for the dividend play, it's called the dividend play, or dividend fishing play. Even though I invest for that reason, I still look at the fundamentals of the company.
Yeah.
Is this company doing well long term? And are they likely to keep on going up or going down? Whatever's happening for them.
Yeah.
I pay attention to that.
So it's not a given that Tesco's will always do well or Sainsbury's will always do well.
Absolutely not.
You're actually researching it and you're setting a bar, and if they fall below that, although it's a necessity that we shop there and buy food and to eat and live and so on, you're still saying, okay, we still need a certain criteria before we invest in that.
Yes. We need to have a few boxes ticked before we say, okay, we're in.
Okay.
And if those boxes aren't ticked, then we leave it alone.
Okay. So that's 4 weeks in May.
Yeah.
5 weeks in May.
Now,
at the end of May.
30th of May is qualification. 31st of May is ex-dividend.
Yep.
And then we have 3 candidates. Taylor Wimpey, Marks & Spencer's, National Grid.
Tell me about those ones then.
Okay. So Taylor Wimpey, so far 15 days have gone by, still waiting for our money.
Right.
Not done well on the upside. But Taylor Wimpey's got some very, very strong fundamentals. But remember, they're in the property game.
Yep.
What's been happening to property recently?
It's been going down in value.
Absolutely correct. So even though their fundamentals are strong, they're in a market that's going the wrong way.
Yeah.
And so, you've got to factor that in.
Yeah.
Okay. So it hasn't recovered yet. Marks & Spencer's. Now, they went through a torrid time,
They did.
And oh my goodness me. But you know what? In this case, 12 days later, they gave you back your money.
Right.
And they gave you a return of 52%.
But they deserted their faithful client base, didn't they? By trying to be young a few years ago, young and trendy with fashion and so on. And then basically their faithful client bank, my age upwards, stopped buying at them because they weren't the clothes they wanted to wear. But they couldn't attract in the younger people because they go, I'm not shopping at Marks & Spencer, that's where my grandpa shops or whatever. And so they tried to change, as a company, they tried to change their whole culture and their client bank. And they suffered for it. But now they're recovering. Is that what you're saying?
I'm not saying that, but what you said is actually correct, by the way.
Yeah.
But I'm not saying that. What I'm saying is that they paid a dividend.
Right, okay.
Yes, and 12 days later, you got your original capital back, and you got a dividend which is equivalent to, or a derivative yield equivalent to 52%. 52%. 2 weeks.
2 weeks, 52%.
Yeah.
How are you getting these figures? Ringing around in your head. If you're not subscribing already, subscribe.
And just so you understand, had you gone with the share, you would have got a 4% dividend yield.
Oh wow!
4% dividend yield, and a 52% derivative yield.
Wow!
In 2 weeks.
Not
so
bad. That's May summed up really.
Basically,
it's pretty good.
The only other one was National Grid. And National Grid hasn't delivered yet on the upside. It's a utility company, hasn't delivered on the upside, but they gave you a 3.4% dividend yield, 46% derivative yield, and you're still waiting for your money back. But again, that one you expect it to take a while. I think I shared with you already. Utilities are great for rewarding short traders, but not long traders.
Okay, that's it on May. Thank you very much for watching. This is a detailed look at May. Keep subscribing. If you're not already on the program, you can go online and just get in contact with Miles through the subscription forms and program, make an inquiry there, and then actually get involved in this dividend fishing. It's quite an exciting and fun way to do it. But do remember, and I'm sure Miles will agree, don't ever invest money that is essential, crucial to your day-to-day living. You've got to actually build up some capital that you're prepared to invest, because there are a risk to everything, okay? A risk to everything. So thanks for watching. Watch more videos. See you soon. Bye.